Venture Capital Part 3. And we're covering a lot of venture capital topics because a lot of the topics within the venture capital industry are relevant to starting a company, starting a new division, working at a large corporation, raising money, meeting potential investors, creating disruptive ideas, etc. Okay, great. So let's move on. So now we're in the third section here. We talked about getting funded by Sequoia. We're not done with Sequoia yet. We're still going to deal with them, but we're also dealing with Kleiner Perkins in this round. So we're now in years 3 to 4 on our journey. In terms of what's next after this, eventually we'll get ready to go public, and then we'll work on maybe breaking up the company or filing for Chapter 11 or selling the company. I'm not going to ruin the surprise for you though, but needless to say, moving through this entire life cycle of a company covers all of the most important topics that you can possibly cover in business education. Okay, so let's move on. Find your passion. Okay, I'm going to repeat this over and over again. If you get out of bed in the morning and you tell yourself you're going to work, then you're doing it wrong. I want you to find what you're most passionate about in life and go after your goals. And we'll do a goal setting workshop later on, which will help you to kind of refine and crystallize what it is you want to accomplish. Okay, so we talked about the jockey being more important than the horse. Investing in the right management team is always incredibly important. As such, venture capital firms tend to always want to bet on the best athlete. Okay, the best athlete. And so we're going to go through a case study. And we're going to deal with a baseball superstar. I'm a huge baseball fan. The Toronto Blue Jays is my team. But we're going to talk about the best player in baseball right now, which is a guy named Giancarlo Stanton. And Giancarlo Stanton plays for Miami. And so he's the best athlete. I thought it'd be fun to talk about in these terms. And Giancarlo also, hypothetically, created a company called PayPal, right? And PayPal, we all know what this brand is. It's basically a way to pay for stuff online instead of just using Visa, Amex, etc. Okay, so Giancarlo is the best athlete there is out there. Okay, so what he did is he designed a proof of concept or a sample product for a revolutionary new payment terminal, or what is referred to as a POS, which is a piece of, it's a proof of, or point of sale product. Okay, so it's a payment terminal, and there's the image of it right there. It's kind of like Square, okay, for this hypothetical example. So he's got kind of a test version or a proof of concept version of this terminal, okay? But he needs $1 million to build a real version of it, not just a prototype version, a real version. And so here comes Sequoia. And Sequoia is the best venture capital firm in the world. And they want to back him. Why? Because they've been incredibly successful in the past backing the best athletes or the best entrepreneurs. And they think they're going to make a 50% return per year over 5 years. Okay. So again, venture capital firms always invest in the very best athlete. Giancarlo Stanton is the best athlete in this example. So when Giancarlo launched his payment company last year, he had $10,000 in equity capital or of his own money. Okay. And he decided to launch the company then last year with 2 million shares. Okay, don't overthink this. Just accept 2 million shares, right? He needs to negotiate with Sequoia on how many shares they're going to get in his company in return for money that he can use to fund his growth. Okay, so Sequoia and Giancarlo agree that in 5 years his company is going to make $1 million in net income. That's pretty good. 5 years from now, he'll make $1 million. Okay, a competitor of Giancarlo's just went public, just did initial public offering. Okay, went in the stock market. And this competitor did this at a valuation of $20 million, and this competitor had $2 million in income. That means the price earnings ratio is $20 million valuation, the price, divided by the earnings, 2 million, 10 times. Okay, a 10 times PE multiple. Okay, a big competitor of Giancarlo's went public at a 10 times PE multiple. So in 5 years, Giancarlo wants to go public as well. Okay, and so the valuation of his company in 5 years should be as follows. If the competitor of Giancarlo's firm is public and trades at 10 times earnings, then his firm should trade at 10 times earnings in 5 years. So in 5 years, Giancarlo's firm is going to make $1 million. And that means a valuation of $10 million in 5 years. In 5 years, his company will be worth $10 million. So what is his firm worth today? Okay, what is his firm worth today? So here's how we get there. Sequoia expects to make 50% per year. Okay, so we have to calculate what his company in 5 years is worth today. So again, in 5 years, his company is worth $10 million. And Sequoia is only going to invest if they can make 50% return every year. Okay, so here's the math. So we discount that $10 million to today. And the way you discount, and we'll cover this during our DCF or discounted cash flow portion in the finance and accounting section of this course, and it won't be dull, I promise you. The way you discount something is you divide it by 1 plus the interest rate or the expected return date, right? And if you do it over 2 years, then you divide it, the valuation of the company in 2 years divided by 1 plus the expected return to the power of 2. But in this case, we're discounting that $10 million, the value of his company in 5 years, to today. And we're doing it at Sequoia's expected rate of return, which is 50%. Okay? And we're going to do it discounted by 5 years, meaning to the power of 5. If we were only discounting it by 3 years, it'd be the power of 3. So we're going to do that. And that equals a valuation today of $1.316872. Okay, so $1,316,872. And so that's how much the $10 million company in 5 years is worth today. Okay. So the value today is that Sequoia owns $1 million worth. Remember, they're investing $1 million divided by 1.32 million. So they own 76% of the company. So that means we own 24%. Okay. Or Giancarlo owns 24%, right? And he's got 2 million shares, right? So total shares is 2 million divided by his 0.24, which equals 8.3 million shares. This is just math, right? So that means Sequoia owns 6.3 million shares. So what is the share price? Well, you take $1 million, right? Which is invested in the company divided by 6.3 million shares for Sequoia. They put in $1 million and they own 6.3 million shares. So the share price is 15.8 cents per share. Okay, that's what the share price is, right? So how much does Giancarlo own? Well, he owns 2 million shares times 15.8 cents per share, right? Which is $316,000. This is called the pre-money valuation of his company, right? And then the total valuation of the company is 8.3 million shares. His 2 million plus Sequoia's 6.3 times 15.8 cents, which equals $1.31 million. If this is complicated, stop this, rewind it a little bit, okay? So the post-money valuation, the value of the company after the money was given from Sequoia is $1.31 million. Okay. Pre-money valuation of the company is before we get money from the venture capital firm. The value of the company afterwards is after the $1 million or the venture capital firm invests. Pre and post valuation. So in 5 years, his ownership, his 24% ownership is going to be worth $2.4 million. Not bad, eh? It's pretty good. Pretty good. He'll be worth $2.4 million in 5 years unless something goes wrong. So we talked about valuation for Sequoia as well, and we know it's going to be $10 million to the value of the whole company in 5 years. What was awesome about what we just did was we didn't build a financial statement. We didn't build an income statement. We didn't build any financial stuff, right? Any statements. We just calculated it, which is pretty cool. So Sequoia just led what's called the A round, or the first round, okay? Giancarlo just did an A round with Sequoia. Lucky him. Sequoia's awesome. Uh-oh. Oh, shoot. Breaking news. So what happened was Giancarlo got injured, right? This is a bit of a setback. He's going to be okay. He got injured. And so this is kind of an analogy for forecasts are often wrong. We tend in business to overestimate what we can accomplish in a year, but we always underestimate what we can accomplish in a decade. Okay, so something happened. Giancarlo got hurt. His company got hurt. Okay, so now we're in year 3 and we need more money. Shoot, we ran out of money faster than we thought we would. All right, so cash is king. Okay, cash rules, right? So we did the A round with Sequoia in year 1. Okay, and in year 5 we want to go public, right? And then Kleiner is now the second venture capital firm, and they're leading the B round. Okay, and they're going to lead the Series B. So we're in year 3, and we need another $1 million. We still want to go public in year 5 at a valuation of $10 million, but we hit a speed bump. And so here comes the dilution. That basically means you're going to own less of the company, or Giancarlo is going to own less of the company. Damn lawyers. So Kleiner expects a 25% return for 2 years until the company goes public. How do they come up with the math to value their stake in the company? Well, Sequoia still expects a 50% annual return. And unfortunately, Kleiner Perkins, which is a great firm, and so is Sequoia, and what they're doing in this hypothetical example, it's not their fault, it's the founder's fault. But Kleiner Perkins needs shares, right? And Sequoia's not giving them up, nor should they. So Kleiner's expected return is $1 million. They're investing $1 million now. At 25% return over 2 years means that in 2 years, their $1 million investment is $1.5625 million. Okay, so Kleiner's ownership is $1.56 million divided by $10 million, or 15.6%. Okay, Sequoia's ownership remains at 76%. Remember, they don't get diluted. So our ownership, or Giancarlo's ownership, goes from 24% to 8%. Kleiner took that stake. Okay, so now we only own 8% of the company, right? But it's at a higher valuation, right? But we'll see. Anyway, we'll cover that later. So how many shares do you own now, or how many shares Giancarlo own now, right? So in total, there's 24 million shares. So in the A round, we issued 24 million shares to Sequoia. They own 18 million shares. In the B round, 15.6% of the company was given to Kleiner. That's 3.7 million shares for them. And before we got diluted, we owned 24% in the A round. After the B round, we now own 8.4%. Yeesh, we got diluted big time. Okay, it actually gets worse because we and Giancarlo forgot about employee ownership via stock options. Remember, you always want to incentivize employees, right, by giving them options, right? And these options only vest or become valid, or you're allowed to cash them in every 4 years, right? So it's golden handcuffs keeping you in place as an employee. Okay. So before we move on, let's analyze the pie chart. This is pie I've eaten, and this is pie I have not yet eaten. Not funny? Okay, sorry. My kid said that would crash and burn. Clearly it has. All right, let's move on. So employees need shares too. Okay, so right now we had to give 6% of shares away to employees. And remember, we owned 8.4% of the company? Well, now that we had to give 6% of shares away to employees because we forgot to include that in our legal documents early on, we only own 2.4% of the company now. It's tragic. Tragic. It's not Sequoia's fault. It's not Kleiner's fault. It's my fault. I'm Giancarlo. I should have accounted for that. I should have hired a lawyer to do all the legal paperwork early on. Okay. So why do we issue stock options? Well, it's cheaper than paying a salary because we don't have that much money, right? So I'm going to give my employees part of the company. And it motivates everybody to work hard as a team. And it's basically golden handcuffs. And there's something called vesting, which means you can't benefit from ownership in stock options until you've held them for 4 years. Okay, so if you work for me, you're an engineer, and I give you stock options. You're not allowed to cash in those stock options or use them for 4 years. And I give you options every year, so it's like a waterfall effect. You'll get to sell them and make money every 4 years, and that basically is golden handcuffs. It keeps you with me. They vest every 4 years. Okay, so now we only own 2.4% of the company. How many shares are there? And we just take $2 million, or 2 million shares divided by our percent ownership. That's 82 million shares. Okay. And the options are that many shares, 5 million shares. So we got diluted by 90%. Yeesh. So outside or venture capital investors are protected against dilution. Okay. Why? Because they own preferred shares. They're preferred. We get common. Giancarlo gets common. Okay. And so you need lawyers. You need lawyers. And founders of companies really need to understand dilution before dealing with venture capital firms, which is why you need to hire a lawyer, okay, when you're starting a company. It's not all that bad, though, because founders of companies get massive option grants anyway. And every year, like Larry Ellison would get a lot of options. Every year, he's the founder of Oracle. And you can pay yourself incredibly well through stock options over the years. And so Giancarlo, no longer injured, he hit the ball out of the park, especially if his IPO was a huge success. Okay. Okay, you get it. So he could actually, hypothetically speaking, be worth a heck of a lot more if the value of his company goes up materially after the IPO. It works out well. But you do get diluted. Just keep in mind, if you deal with a venture capital firm or equity investors as opposed to banks, you're going to give up ownership in your company, right? But hopefully your company's worth a lot more money over time, so it becomes a moot point. But don't do debt if you're an early stage company, because if you have one little hiccup like we just did here with Giancarlo, you're done. You're done. Banks don't care. If you miss one payment, they'll screw you. They'll take everything. Okay, but it's okay because you're protected, and so is your family, because you have an LLC or limited liability corporation structure set up. So why do a B round? If we were tracking to 10 million bucks in net income by year 5 instead of $1 million bucks. And we wanted to accelerate growth, just grow a lot faster, then we can raise a certain amount of money at a much higher valuation in the Series B, right? And we can grow instead of just domestically. We can get enough money to grow overseas. That's called leverage. Okay. So let's talk about a little bit more VC terminology. We talked about unicorns in length. The probability is less than 0.07% of having a unicorn or $1 billion plus valuation company. I want to talk about black holes or Walking Dead. Okay, so a lot of deals end up just breaking even or a black hole. So you just got to know when to fold. If you worked a couple of years in your venture and it's not going anywhere, that's cool, man. Just shut it down and move on. A lot of the most successful entrepreneurs in the world have failed many times before they succeeded. Michael Jordan once had this great quote. He's the best basketball player of history, of course, in history. He said that I failed many times in life, and that is why I succeed. Okay. So venture is very hard. In order to return the capital on a $400 million fund, you have to have 20% of your fund or 2 unicorns in your fund. It's really tough, especially when you get bigger funds. Bigger funds, it's harder to make a lot of money on because there are fewer investment opportunities because you have to invest big amounts in companies like, I don't know, Uber or Airbnb, whatever it might be. Okay, great. So we talked about unicorns. It takes about 7 years on average from founding to IPO. In San Francisco now, actually, interestingly enough, and not the valley, meaning not the area south of San Francisco, is the new home of unicorns. And the average founder age is 34, a lot of young people here. And in terms of number of founders per company, there's usually a couple. There aren't that many companies with just one founder anymore, right? We talk about the odds of creating a $1 billion plus company. It's tough. It's tough. So San Francisco is now the home of all the cool companies. Okay, so the valley, which is on that graphic south of that little green square airport logo, the valley is where all the old school companies are, right by Stanford. eBay, Google, old school, I know. Yahoo, Oracle, EA. And all the cool new companies are up in San Francisco there, like Airbnb or Uber or Salesforce. AppDirect, Udemy, of course, which is an awesome company, by the way. Square, Zynga, yada. You get it. So the new disruptive tech companies are up in the city. San Francisco is seeing a big renaissance, and the old boring tech companies are down in the valley. Okay, and so Salesforce.com, Mark Benioff. Salesforce.com, Mark Benioff's company, is building the largest office tower in the history of San Francisco. It'll be up and ready within a couple years. And just the landscape in San Francisco is changing materially. Most people want to be in the city now and no longer the valley. Okay, 140 character class recap. We discussed the first round, the A rounds. We talked about valuation and dilution. I know it seems a little bit complicated. Don't worry about that. Okay, we're going to do an easier example later. We talked about the B rounds. We talked about option pools, the importance of contracts, legal contracts. And we talked about unicorns again very quickly, and then just other VC terminology.